Welcome to Next in Tech, an S&P Global Market Intelligence podcast where the world of emerging tech lives. I'm your host, Eric Hanselman, Chief Analyst for Technology, Media, and Telecom at S&P Global Market Intelligence. And today, we're going to be discussing venture capital and the financial markets with my guest, Melissa Incera. Melissa, welcome to the podcast.
Thanks, Eric. It's awesome to be here.
And it's great to have you here. I mean, especially given with all of the turmoil, the macroeconomic ebbs and flows, everything we've been talking about around venture capital markets. Of course, there's a lot that's been going on that's top of the news that we can dig into. But I thought it was interesting, as we've had a chance to talk before, you had some insights about investment perspectives that maybe give us something of a silver lining.
Yes, definitely. It's certainly a very interesting time in the venture space right now. And when we go out and we talk with companies and we talk with investors, we're hearing very conflicting sentiments about the current environment.
Conflicting in this market. Surprise, surprise.
Yeah, I know. Shocking.
Well, it's something that I guess we've been used to so many sort of downside perspectives on where the market is and how horrible things are and slowdowns and all the rest of this, but other pieces that might potentially shine a light on that?
Yeah. And of course, I don't want to downplay the slowdowns, right? One really important piece of this is that tech has absolutely taken a beating, particularly on the venture side, which has suffered a really long cycle of interest rates. Growth is slowing. A lot of funds have been forced to very aggressively write down the value of their portfolios. So I wouldn't say that it's a very happy time for the venture community. There's a ton of downward pressure. Just to contextualize and kind of level set before we get into the details, if you look at venture capital deployments in Q1 2023, investors are logging just about half as much tech investment as they did in the same period a year ago. So broadly, confidence in tech is very low at the moment. However, and speaking to that silver linings tease you set me up with, most investors will also tell you that we are in this golden era of investment. We have a lot of startups that are in pretty serious cash crunches. Valuations have basically reset in the last year. So from a kind of returns perspective, it's a great time to be throwing cash into the market. The interesting piece is that it doesn't feel as good to be investing now as it did in 2020 and 2021. But the expectation is that the returns will be better.
We're getting to an environment in which valuations might actually be approaching sanity, that in fact, this is a point in which there isn't that same level of, dare I say, irrational exuberance that may have existed, but there's some reality that's starting to turn to this. And I guess it seems like that's an environment in which, from an investor perspective, we get that shift to it being returning to an investor's market rather than a startup market.
Exactly. And I think this is probably a good point to bring up Silicon Valley Bank, which...
Everybody's favorite subject.
Yes.
Not so much, yeah.
Very topical. And luckily, most of the companies and investors that we've talked to are kind of on the other side of this, relatively unscathed. They've moved their funds. But broadly, the effect of this has been to amplify this crisis of confidence that is in part making this such an opportunistic time for VCs, right? So over the course of the last few months, we've seen this divide widening between companies that are in a strong cash position and those that are in weak one. And a lot of those that are in weak ones are dependent on the venture community. And because they've been faced with this threat of survival, there's almost like a cultural reckoning where they're coming around to the fact that, hey, we need cash in order to survive. And our valuation is just nowhere near where it was the last couple of years. So
basically, the Silicon Valley Bank disruption, however you want to label it, was enough of a shock to the system. But I think the really interesting point that you're pointing out is that it has created this underlying cultural shift.
Exactly.
In that expectations have started to move. And it sounds like that's something that may in fact be more productive in the venture and startup community in the longer run. That makes sense?
Yeah, I believe so.
It's something where if you think about what's taking place, because it's actually, you're raising some points that Brennan had touched on a few episodes ago, which was that the startups tend to be the the lagging indicator or the last ones to know, however you want to lay it out, in terms of where valuations are. And that a lot of the macroeconomic stress that's existed hasn't really reflected back into the venture community and specifically to startups and expectations sort of over the course of this until now. And now we've got a little more reality being, I guess, injected into that environment to hopefully get everybody a little closer. Because the thing that I talked about was that gap between expectations in valuations and fundings, and that a lot of things just simply weren't happening because expectations on valuations from the startup side were unrealistically high.
Yes. So because the private market has been in such a state of flux, and I know you talked about this when you talked about M&A, but you get this gap where buyers and sellers feel almost like they're on separate planets when it comes to valuing a business. And as you said, that spread has acted as somewhat of a bottle stop for M&A and also funding, because a lot of companies just couldn't reckon with the fact that their valuations had come down so far when they're doing the same things as they were 18 months prior. Likely they've posted some growth in that time. So many, at least in the early days, were just hoping to wait it out, looking how can we extend our runway so we're not raising in these dark days. But bringing it back to that cultural shift that we're talking about. So now we're about a year into this down cycle, and many are realizing that drought is going to last a lot longer than expected. So let's talk about down rounds. If you were raising a down round last year or even 3-4 years ago, that was considered a really, really bad time. Some would have said maybe the kiss of death. Now, the expectation is if you are raising cash in this environment, A, you're one of the lucky ones, but B, it's expected to be a down round or at the very least flat.
Well, and it seems like anytime you wind up getting valuations that shift like that, now you open up new opportunities.
Exactly.
And corporates have been sitting on the sidelines for a bit because they saw valuations seem to be too high, or at least higher than they were willing to pay. And now we're in that sort of next stage.
Yeah. And I would say that referring back to the kind of the interesting position that specifically the venture community is in, there's this understanding that this is a great time to invest. But there's also a contraction happening in terms of capital availability. So now it's becoming a question of, can we invest?
There's no more free money. What are we going to do?
Exactly.
Well, of course, we saw that in private equity right away. But we do seem to be now sort of shifting into the next set of those repercussions for actually having, to pay interest on debt and things that historically the market didn't have to account for.
Yeah, absolutely. And I think broadly, we've seen this decade plus of capital expansion within the tech markets. And that's starting to, I don't want to say reverse, but it's starting to contract somewhat. So VCs and private equity, their lifeblood comes from two sources: debt, which I believe you covered with Brennan, right? Getting more expensive. Banks are getting more risk averse.
Well, again, the fact that money now costs something.
Exactly. Right. But also on the fundraising side, it's getting a lot tighter because we're seeing a lot of the limited partners who hopped in on the funding frenzy, in the last 4 to 5 years are just effectively seeing their returns wiped out last year. So actually 2 weeks ago, Tiger Global announced that effectively they lost 30% of their portfolio over the course of 2022. So this means there's less ability and less willingness to toss huge sums of capital into these funds, which is making fundraising a heck of a lot harder for these guys.
Less fuel for the fire.
Exactly.
So what does that mean on the VC side? Because, of course, from the VC perspective, that fuel is normally what is going to help them build funds for investment. What do you see happening there?
Yeah, it's interesting. So on top of the fact that fundraising is slowing, I think fundraising is pacing at about only a third of this year what it was last year. So on top of the fact that it's just slowing, additionally, fundraising is concentrating with the proven, well-known VC firms that have been doing this for a long time. So there are going to be a lot of firms and funds that are going to have a hard time raising cash and effectively surviving this contraction period.
Oh, so a situation where, much like we see in the markets, there's a flight to perceived quality.
Exactly.
And it's the old guard that's getting that investment. You're identifying that now with valuations lower, the fact that there's a little more reality in the market, it seems like this is now a better time to invest. But yet, it seems like there's still that concern that, all of this hasn't shaken out, the other shoe hasn't dropped, whatever, that's keeping some of that money on the sidelines. Is that one of the things that's really hurting that investment pipeline? Are there other aspects that are in play?
Yeah. And here's where there's even more cognitive dissonance at play. So we just talked about how there's a problem with the inflow, that capital raising is getting harder, raising debt is getting harder. But we can't talk about the position of these institutional investors without acknowledging the fact that there's still a record amount of dry powder in the market.
So yeah, there's cash there. Everybody's just worried about doing anything with it.
Exactly. It looks a little bit almost like hoarding, where they're seemingly in a position to act, but they're biding their time. And when we talk to investors, it's clear that this is all really hinging on global monetary policy and these cycle of interest rate hikes that everybody's waiting on some signal that they're coming to an end, which many people believe will likely correlate with a bottoming out of private and public markets.
Well, and I can imagine that an upset like the Silicon Valley Bank situation is only going to make people more cautious because, they went through a situation in which there was concern that there would be significant unavailability of funds. Granted, nothing got lost, but that seems like that would only reinforce that kind of behavior.
Definitely. So what's happened with Silicon Valley Bank is perpetuating what is already there. Risk aversion, the fear of overvaluing, of overpaying. So it's really just playing to very real fears as to whether or not policymakers are going to be able to thread the needle and bring inflation and employment numbers back in check without completely crippling US and other economies globally.
Are there places, we would talk about, flight to quality kinds of issues. Are there places where investment is happening? Are there sectors or specific, types or styles of startups that are seeing investment?
Yeah, it's a great question. If I can generalize, I think there has been a rotation into tech categories that are a bit more resilient to downturns, right? So this is security, InfoSec, energy.
Our favorite always.
Your favorite. Yeah, it's been relatively healthy in security.
Yeah, spending and budgets are still strong. So, yep.
Right. And other categories that are similar to that, right? Like back office technology, as well as some that are a bit more speculative or undergoing a massive transition like energy. But to your question, part of the reason that it's such an interesting time to invest is most people in the industry feel that we are on the cusp of a very transformative generation of tech with AI. So,
now we're getting into the chat GPTs. I noticed if we're talking about buzzy topics, you weren't saying metaverse. So I guess the generative AI thing we'll have to do for our buzzy topic of the day. So
they couldn't resist.
Well, with Microsoft throwing a few $1 billion at a technology, you think others would follow suit? Who knew?
Yeah, and it feels like, everybody I've talked to mentions it, right? Everybody's looking to place bets here, whether it's in the underlying infrastructure, whether it's in the AI models themselves, whether it's in applications. So this is certainly the subsector that has the most enthusiasm at the moment. And actually, if you look at the tippy top of the venture market, so rounds that value the companies at over $1 billion, thus far this year, a massive chunk of those, and basically all of those that involve early stage rounds, are these types of AI companies, specifically generative AI. So there's hype and there's also cash coming in behind it.
Well, cash to fuel the hype. Again, that's the other thing that we also wind up seeing on the research side is that there is that significant potential. But the challenge, of course, when you get into that sort of gold rush situation is making sense of how the technology gets used, who's actually going to be doing useful things with it. All those more complicated questions of, okay, there's a lot of potential here. You look at what generative AI can do. We've been talking about not only the fundamental pieces of generative AI in user interface. Johan Fermé was on talking about generative AI in manufacturing, taking a look at more sophisticated, 3D manufacturing techniques. There are all sorts of pieces that we can potentially do. The big question is, all right, which of these approaches is actually going to bear fruit? And it is going to be significant enough to be able to generate real returns from the applications they're trying to cover.
Yeah. And to your last point, so before we were talking about sectors that are really seeing resilience and still seeing strong amounts of funding. I think two broader trends that are worth pointing out. One you already mentioned is the flight to quality across the valley. So companies that, as you're saying, have healthy cash flow, have a path to profitability, are still posting really strong growth despite the headwinds at the moment. These are the companies that are likely to find willing bidders from either an investment perspective or a buyer, right? And then just to follow up on that point, we're also seeing more resilience within funding for more mature companies that are just too big to fail at this point. So a very public example would be Stripe. I don't know if you saw the news a few weeks ago.
Yeah.
They were gearing up to go public, but behind them, they had a lot of high-profile investors who basically are going to refuse to let it fail, right? This is our big bet. So Stripe took a 50% haircut, but it raised, I think it was $6 billion in funding, which is a huge round.
Yeah, if you look at that kind of money, it's just like, holy cow. It's like,
right.
You wind up doing an investment turn that actually looks like an IPO when you start thinking about the kind of money that gets generated around that. But I guess, to your point, you've got all this money, in the system, and there's an opportunity to go with something which seems like, a solid investment. A lot of cash is going to flow that way.
Right. So there's still cash available. It's just being placed with much more stringency.
Yeah, a lot more serious assessment. Well, I mean, we've come out of an environment in which concerns like profitability sat on the back seat when we were looking at growth. And now that we're in a world in which there's less speculation, cost of investment is higher, concerns about overall macroeconomic outlooks are maybe a little more dour. People are a lot more careful, but to your point, it sounds like there at least is cash out there, but it's money that's going to be placed more carefully.
Exactly.
All the chips in on the table isn't as likely to happen as I guess, at least that we've certainly recently seen historically.
Yeah.
No more Las Vegas, at least in the Silicon Valley front. But it sounds like, at least with that in mind, there are reasons for optimism.
Yeah, I believe so. I think it's important to keep a couple things in mind, especially given the kind of dourness and negativity that exists around tech right now. One is that Silicon Valley is still creating a ton of value, right? There are still strong businesses. Most of them are still doing the same thing that they were doing a year ago when their valuations were a third higher. I think a lot of investors are going to look back 4 to 5 years from now and think, why wasn't I more aggressive? If you want to optimize returns, this is the time to be aggressive for those that are in a position to be, which is the big caveat. And the route won't last forever. So my expectation, and I think that of some of my colleagues, is that the private markets in particular will bottom out in the next few months. And we're expecting to see investment come back middle to late 2023. So although we're in the thick of it right now, generally our expectations are that things are going to come back. Maybe not come back the way that they were, but certainly look a bit healthier in the second part of this year.
So there's a light at the end of the tunnel. We can maybe see that approaching. And to your point, we're in this market in which there is still a lot of value creation that's taking place. And there are a lot of products out there, a lot of companies that are producing useful things that, if we can get beyond the concerns about macroeconomic perspectives, all of the upheaval of the banking markets, which, to your point, so much of this is about perception.
Right.
And it's about concerns about how soon will it get better? How bad is it now? and what's the path, to whatever the next stage is. But that's at least a lot more light than we have been discussing historically here on the podcast of the market. So it is great to have at least a little bit of a positive view. I guess we keep fingers and toes crossed for the near term, though.
Yeah, absolutely. And there's still an outrageous amount of uncertainty. We have a banking crisis potentially looming. So as always, when we're talking about M&A and financial market, it's just our best guess at the current time, right? But we're definitely hearing more optimism from the market itself, which carries a lot of weight.
Well, it's one of those things that, those slight inklings. I mean, hey, much the same way spring starts to arrive, at least for those of us in the Northern Hemisphere, as it's, little green shoots that are coming up. Maybe these really are, the plants that will grow to a wonderful bloom in the not too distant future. So we'll have to see what happens in terms of turning that into reality.
Yeah, absolutely. It will be interesting to watch the next couple months.
Well, and to that end, it's like any investment, if things actually pan out, you never invested enough. If they're not doing well, you invested too much. We'll have to see where things go. Well, I appreciate all the insights, Melissa.
Thanks for having me, Eric. It was so much fun.
Well, and it's so much more positive than the more recent message. So again, every little positive nugget I will hang on to. So again, fingers and toes crossed. But thanks for being on the podcast.
Thank you.
And that is it for this episode of Next in Tech. Thanks to our audience for staying with us. And thanks to our production team, including Carolyn Wright, Ethan Zimmon, and Syed Waji Abbas on the marketing events teams, and our studio team, Kyle Cagnolosi, Derek Brown, and Darren Rose. Join us for our next episode, where we're going to be talking about application networking. We're going to dig back into interconnecting technology. I hope you'll join us then, because there is always something next in tech.